So in the last sessions, we discussed about a brief view relating to accounting standard 14. So in the accounting standard 14, we discussed about what is amalgamation, what is merger, what is absorption, and what is external reconstruction. So now, as per our Ind AS, so how to do accounting for business combination? Ind AS 103 deals with business combination and IFRS 3. IFRS 3 is also deals with business combination. So as we know that Ind AS are converged form of IFRS. So what are the elements are there in IFRS? At the same time, what we are newly introduced in the Ind AS 103, we are going to discuss. So here, in the business combination, all the types of amalgamations and mergers will came into existence. Okay. So here in the business combination, write down amalgamations, mergers are part of business combination. So when we are doing any amalgamation of companies or mergers, in that case, we have to follow the rules of Ind AS 103. So as per Ind AS 103, follow acquisition and purchase method. And only one case, so we will follow pooling of interest method. That is business combination under common control. So when business combination under common control, we will use pooling of interest method. And this common control aspect only we are having in Ind AS 103, which is not there in IFRS. It is carved in Ind AS 103. So for that, they have given one appendix. Appendix C of Ind AS 103 deals with business combination under common control. So before going to that, where we have to follow Ind AS 103. Okay. So it is based on investments. So don't write anything, just you listen first. When we are making investments in any other entities, So investment in any other entities means generally the size of the investment we have to take care. So have you know about IPL? What is that IPL? Now we will play Investment Premier League. Okay, so this IPL, Investment Premier League. So we can check some matches like case 1. So case 1, see, if entity 1 invested in entity 2, entity 1 invested in entity 2, so that here E1 will be the investor company, and E2 will be the investee company. Now the size of investment is 1 to 19 percentage. So 1 to 19 percentage of shares we are having in E2 Limited. So even Limited having 1 to 19, up to 19% of shares. So that means shares means here equity interest. So 1 to 19% of equity interest they are having in E2 company. This investment we can call it as normal investment. So when you made normal investment means we are invested 1 to 19%, 12%, 13%, 18%, whatever, up to 19 percentage. When we are investing in any other company, that will be considered as normal investment. How to do accounting for this normal investment? So accounting for these investments as per Ind AS 109. So we have to apply Ind AS 109, which is nothing but financial instruments. Okay. So when we are making a normal investment means the size is up to 1 to 19 percentage. In such condition, we have to apply the rules of Ind AS 109, that is accounting for financial instruments. So Ind AS 109 will apply. Here, no need to prepare consolidated financial statements. Okay. So only we are having standalone financial statements. So only standalone financial statements we will prepare. In that financial statements, how to do accounting for investment means as per Ind AS 109. This is case 1. Okay. So all together you can copy now. So case 2. So here the other entities, entity E3 invested in E4. So E3 will be the investor company and E4 will be the investee company. Okay. Now the size of investment is 20 to 50 percentage. Size of investment is 20 to 50 percentage. When your size of investment is 20 to 50 percentage, that means entity E3 having a stakes in E4 Limited up to 50 percentage, 20 to 50 percentage, 28%, 32%, whatever it might be. So then we can say this is an associate company. Investee company will be the associate company. So this investment will be considered as investment in associate company. So when you're having a stakes up to 50 percentage, more than 20%, up to 50 percentage, then we can say it is investments in associate company. So next, in such conditions, investor company will prepare two financial statements. So they will prepare separate financial statements as well as consolidated financial statements. So when we are having investment 20 to 50 percentage, so here the company, investee company, we can call it as associate company. In such condition, investor company will prepare two types of financial statement. One is separate financial statement, another one is consolidated financial statement. So separate financial statement means only information of investor company will be there. Consolidated financial statement means here both investor company and investee company details will be there. So here, separate financial statements they will prepare as per Ind AS 27. So Ind AS 27 is deals with separate financial statements. Ind AS 27 means preparation of separate financial statements. In such condition, when we are making investments in associate companies, consolidated financial statements will be prepared as per Ind AS 28. So Ind AS 28 will apply in such cases when you are preparing consolidated financial statements, when you are making investments in associate companies. Investments in associate companies we have to follow when we are preparing consolidated financial statement. The Ind AS 28. Ind AS 28 will apply. So Ind AS 28 is nothing but investments in associates and joint venture. Investments in associates and joint venture. So when we are making an investments in either associate companies or joint venture companies, consolidated financial statement we have to prepare as per the rules of Ind AS 28. Ind AS 28 will apply, that is investments in associates and joint venture. So two cases we have seen. The first one, Nana, 1 to 19 percentage. When we are having 1 to 19 percentage, we will consider it as normal investment. In case of normal investments, when you are making, no need to prepare consolidated financial statements. In the standalone or individual financial statement itself, we will record such investments as per the rules of Ind AS 109, which deals with financial instrument. When we are making investment, that is our financial instrument. Okay, so as per Ind AS 109 rules will apply. Ind AS 109 we are having a separate chapter. Okay, so there we can discuss how to do accounting for financial instruments. Okay, and coming to the second case, if you are making investments 20 to 50 percentage, if the size of investment is 20 to 50 percentage, the investee company will become your associate company, and the investment will become investments in associate companies. When we are making investments in associate company, investor company have to prepare two financial statements. One is separate financial statement and one is consolidated financial statement. Separate financial statement they have to follow Ind AS 27, and consolidated financial statements they have to follow Ind AS 28. Ind AS 27 deals with separate financial statement. Ind AS 28 deals with investments in associates and joint ventures. This is the second case. Okay. Now, third case. Now, entity E5 invested in entity E6. So here it is investor company, investee company. So now the size of investment is more than 50 percentage. More than 50 percentage. If any company holds more than 50% of stakes in any other company, so then we can say the investor company will be called it as holding company, or the company itself parent company. So this we call it as either holding company or parent company, and investee company will be the subsidiary company. When we are making investments more than 50%, if you hold more than 50% stakes in any other company, immediately you will get control over that company. So what we will get? Control over the company. Now who is controlling whom? E5. E5 company is controlling the E6 company. How they attain the control? Why they get the control? Because more than 50% of stakes is holded by E5 Limited, so they will attain a control. In such conditions, investor company have to prepare again two types of financial statements. One is separate financial statement, another one is consolidated financial statement. In separate financial statement, they will prepare as per Ind AS 27. Ind AS 27, which deals with separate financial statements. Now, this is the question. Consolidated financial statements, when we are preparing investments in subsidiaries, can I call it as investment in subsidiaries? Because more than 50% of stakes we are holding. So that is an investment in subsidiaries. When we are preparing consolidated financial statements, we have to check two criteria again. So we have to prepare consolidated financial statements two times. Okay. One is at the time of acquisition. At the time of acquisition. At the time of acquisition. So at the time of that business combination, or at the time of acquisition, and at the end of the financial year. At the end of the financial year and subsequent years. Okay, so consolidated financial statement we will prepare at the time of acquisition of the business. At the same time, we will prepare at the end of the financial year, and every year ending we will prepare. Okay, and subsequent years. At the time of acquisition, we have to follow to prepare consolidated financial statement as per Ind AS 103. So business combination will be happen when at the date of acquisition or at the time of acquisition. So on the date of acquisition or at the time of acquisition, we have to follow Ind AS 103 rules for preparing consolidated financial statements. Ind AS 103 deals with business combination. So when we are preparing consolidated statements at the date of acquisition, on the date of acquisition or at the time of acquisition, we will prepare consolidated financial statement as per the rules of business combination, as per Ind AS 103 will come into play. So at the end of the financial year and subsequent year also, we have to prepare consolidated financial statement that we will prepare as per Ind AS 110. 28 is investments in associates and joint venture. This is investments in subsidiaries. So consolidated financial statement, we have a separate standard. So that is Ind AS 110. So that is nothing but consolidated financial statements. This is our next chapter. Consolidated financial statements. That is Ind AS 110 will come into play. Okay, so now here when an investor company making investment more than 50% in the equity interest, that means investor company holds more than 50% of stakes in any investee company, then that investee company will be our subsidiary company. So when you are making investments in subsidiary company, investor company have to prepare two types of financial statements, and at the time of when we are making the financial statements, we will prepare two financial statements. One is separate financial statements and consolidated financial statements. Separate financial statements we will prepare as per the rules of Ind AS 27. When we are preparing consolidated financial statements, we have to check at the date of acquisition one consolidation financial statements we have to prepare. At the end of the year also we have to prepare consolidated financial statements. At the date of acquisition, we will prepare that consolidated financial statement as per Ind AS 103. So Ind AS 103 will come into play at the date of acquisition or at the time of acquisition. So their business combination will apply on that particular date. So in the business combination, every time when we are doing accounting, that accounting is on the date of acquisition. On the date of acquisition we are doing. So in the amalgamation, I told you on the date of amalgamation we have to take the values. So here also on the date of acquisition we are taking the values. And at the end of the year and subsequent year, every year we have to prepare consolidated financial statements, that is as per Ind AS 110. 110. Ind AS 110 will come into play when we are preparing the consolidated financial statements at the end of the year and from there onwards every subsequent years. Okay, so that is the third case. First you write it down. First case is relating to normal investment. Normal investment means the size of investment must be 1 to 19%, in between anything. In normal investment, which accounting standard will apply, Nana? Ind AS 109, which is related to accounting for financial instruments. The difference between standalone financial statement and separate financial statement. Generally, the core aspect is same. But when you are preparing consolidated financial statements, so we will call that financial statement as separate financial statements. Because we are preparing two financial statements, no? One is consolidated, remaining one is separate. Separate means only for that particular company. Any company who is not required to prepare consolidated financial statement, then single financial statement they have to prepare, that we call it as standalone financial statement or individual financial statement. So in the first case, it is not required to do consolidation. So consolidated financial statement is not required in the first case. That's why I told you it is standalone financial statement. You can write separate financial statement also, no issue. Okay. So individual financial statement also, no issue. Completed. Second case is related to investments in associate companies. So when you are saying that it is an investment in associate company, when the size of investment is 20 to 50%. In between that, if the size of investment is there, then we can say it is an investments in associate company. Investee company, we can call it as it is my associate company. In associate company, when you are making investment, you are not having control. We are not getting any control over our associate company, but we are having a significant influence. Okay. Significant influence will be there, but not the control. We cannot say. We can say our opinion, but we cannot control the business. So when you are making an investment 20 to 50%, we can say it is our associate company. When we are making investment in associate companies, compulsory we have to prepare two financial statements. Who have to prepare? Investor company have to prepare two financial statements. One is separate financial statement, another one is consolidated financial statement. Separate financial statement, consolidated financial statement. Separate financial statements we will follow Ind AS 27. 27 is okay, alone it deals with only separate financial statement. So consolidated financial statements, Nana. Ind AS 28 will apply here. Consolidated financial statement, Ind AS 28 will apply. Ind AS 28 deals with investments in associates and joint ventures. Investments in associates and joint ventures. Completed. So third case, when we are holding more than 50% of stakes, then investor company, we can call it as holding company or parent company, and investee company is our subsidiary company. So when you are holding more than 50% of stakes in any other businesses, you will attain a control over the business. So now E5 can control the business of E6. So E5 is having a control over the business of E6. In such condition, E5 have to prepare two financial statements. One is separate financial statement, another one is consolidated financial statement. So more than 50% stakes, more than 50% means sometimes 100% we will take, sometimes 90%, 80%, 60% or whatever. So more than 50% of stakes when you hold, you have to prepare two financial statements, separate financial statements and consolidated financial statements. The major aspect is control. Nana. We are attaining control in this case. Okay. So we are preparing two financial statements. One is separate financial statement as per the rules of Ind AS 27. Separate financial statements, Ind AS 27 will apply. For consolidated financial statements, we need to check at the date of acquisition or at the end of the year. At the time of acquisition, we are preparing the consolidated financial statement as per the rules of Ind AS 103. Business combination will apply at the time of acquisition. And at the end of the year, Ind AS 110 will apply. This is after acquisition or before acquisition? After acquisition. After acquisition, at the end of the year, we will apply Ind AS 110 for the consolidation. Okay, ma? So on the date of acquisition, we will apply Ind AS 103. At the end of the year, we will apply Ind AS 110. This is at the end of the financial year and subsequent year onwards. Ind AS 110 will apply, that is consolidated financial statement. Ind AS 110 deals with consolidated financial statement. We discussed in case 1 Ind AS 109, that is for financial instrument, accounting for financial instruments. While coming to case 2, we discussed about Ind AS 27, separate financial statement, Ind AS 28, consolidated financial statement for investments in joint ventures and associates, investments in associates or joint ventures. And third case, investments in subsidiaries. Again, we are preparing two financial statement, separate financial statement as per 27 and consolidated financial statement we have to check on the date of acquisition at the end of the year, at the end of the financial year. On the date of acquisition, Ind AS 103 business combination will apply. Ind AS 110 will apply at the end of the year. At the end of the financial year, we will apply that. Okay. So here, when we are doing Ind AS 103 business combination, most of the elements what we are doing accounting in here, the same thing will be there in consolidated financial statements also. So it is a continuation topic. So actually, business combination properly when you understood, then consolidation will be quite easy. Okay, the consolidated financial statements, the continuation of business combination. Okay, so and next case, 3 cases completed. Case 4. Now E7 and E8 entities. 7, 8 kada? E7, E8, two entities are there. They are doing joint arrangements, Nana. Not joint venture. I am telling you joint arrangements. So joint arrangements, which is nothing but joint operations. Sir, what is joint operations? Joint venture means you know that. So generally till the completion of that venture, they combinedly doing the work. So while coming to joint operation is the same thing. So when they want to do, so they will bring some assets. One company will bring the assets, other company will bring other resources. Okay. So no rice is run in curries pedatan annattu. So here, like that, so they are making some joint arrangements. They're pooling the resources and doing the business. That we call it as joint arrangements. Now, joint arrangements is a broader word. In that joint arrangements, joint operations will be there and joint venture will be there. In the joint arrangements, joint operations will be there, joint venture will be there. We are discussing about joint operations. So for this, we are having a separate standard for joint arrangements. We're having a separate Ind accounting standard for joint arrangements. So in case of joint arrangements also, no need to prepare consolidated financial statement. So only standalone financial statement is required or separate financial statement. Only one financial statements they will prepare. Individually they will prepare. E7 will prepare and E8 will prepare the standalone financial statements or individual financial statements or separate financial statements, anything it might be. But these statements, they have to follow the rules as per Ind AS 111. Ind AS 111 will apply for joint arrangements. Ind AS 111 will apply for joint arrangements. So when we want to discuss relating to what is the difference between joint venture and joint arrangement, that we will discuss when we are dealing with the theory aspect. Okay. So here not much difference will be there. So one we are taking individual assets, one we are taking net assets. That is the only difference. In the examination also they asked the question from this, in the multiple choice question. So that I will tell you. So generally if two companies are doing joint arrangement businesses or joint operation businesses, they will prepare only standalone financial statements. That too, they have to follow the rules of Ind AS 111, that is joint arrangements. Joint arrangements. Ind AS 111 will apply. This is only an exceptional case. Okay, last case. So first to write down this. if two entities are doing joint arrangement operations or joint operations, so then they have to apply Ind AS 111, that is accounting for joint arrangements. Okay, so we are not having the complete details relating to Ind AS 111, only theoretical aspect is there that we will discuss when time comes. So when Ind AS 111, we will discuss at that time, I will tell you in a clear manner, so what to do in the joint arrangements. Accounting is not required. This is case 4. First case is related to normal investment. Second case, investments in associate companies. Third one, investment in subsidiary companies. And fourth one, so doing business of joint arrangements. Any two companies are doing joint operations or joint arrangements. So then we have to apply Ind AS 111. Ind AS 111 will apply. And case 5, last case. So entity E9, E10 are doing joint venture business. They formed a joint venture company and they're doing the business. In such conditions, they have to prepare both separate financial statement and consolidated financial statement. Separate financial statements, they will follow Ind AS 27, which is separate financial statements. So when they do consolidated financial statements, Nana, Ind AS 28 will apply. As I told you, investments in associates and joint venture. Associates and joint venture. So Ind AS 28 will apply for these cases. Investments in associates and joint venture. That means case 2 and case 5 we are using the same. So investments in associates and joint ventures. Okay, so once you go through all the 5 cases, so when we are applying business combination Ind AS 103, so only at the date of acquisition. On the date of acquisition, acquisition means when you are purchasing the business, you are acquiring the assets and liabilities of another company. That means acquirer company. Here we are discussing in different way. In the amalgamation, as I discussed with you, transferor company and transferee company. But here we are calling it as acquirer company and acquiree company. Acquirer company and acquiree company. Acquirer company means the company which acquires the assets and liabilities of acquiree company. Okay, so that means here transferor company will be the acquiree company. Transferor company will be the acquiree company. So who is getting the assets and liabilities, Nana? Transferee company is getting. So transferee company, here we can call it as acquirer company. Okay, so that's why you forgot transferor and transferee for some time. Transferor, transferee, leave it. Acquirer company means the company which acquires the assets and liabilities. Okay, acquiree company means on which company assets and liabilities are acquired, that we call it as acquiree company. Acquiree company. So two companies we are having here. Okay, if X Limited acquires assets and liabilities of Y Limited, that means from Y Limited all the assets and liabilities will be transferred to X Limited. No? So here X Limited will be the acquirer company and Y Limited will be the acquiree company. Okay, so in amalgamation side, who is transferring assets and liabilities? Acquiree. Then here we can call it as transferor. So here we call it as transferee. So just you leave it, transfer or transferee relation, leave it. So here we are having majorly acquisition method we are using. So we are using the words acquirer company and acquiree company. So the company which acquiring the business of any other company. So then we can call it as acquirer company. The other company will be the acquiry company. That means from acquiry company, assets and liabilities are transferred. Assets and liabilities are transferred. Now, which company is a purchasing company then? Acquirer company is a purchasing company. Which company is selling company? Acquiry company will be the selling company. Okay. So here, after this, once you go through all the 5 cases, Nana, we will start with the business combination from the roots of definition onwards. Okay. Once you go through all the 5 cases, the Ind AS numbers are very important. Individually, we will do Ind AS 109, we have a separate standard. Ind AS 110, we have a separate standard. Okay. Ind AS 28 is also a part of business combination. When it comes, I will discuss about Ind AS 28 also. Okay. A separate accounting treatment will be there for that. So here, major, our concentration should be on Ind AS 103 business combination. How we are doing the business combination, that is a major aspect. Most importantly, case 3. So more than 50% of stakes when you hold, you will attain a control. So we will attain a control. At the same time, we have to prepare separate financial statement and consolidated financial statement. In the examination, when we are doing consolidated financial statement, Ind AS 110, they will ask you separate financial statements also. So we should know how to prepare SFS as well as CFS. So here, CFS and SFS that we will prepare under Ind AS 110 itself. Here our concentration is business combination. That means at the time of acquisition, how to do the accounting. So up to that only business combination will tell you at the time of acquisition how to do accounting for business combination. Business combination is nothing but either amalgamation or merger is taken place or acquisition is taken place. So acquisition is nothing but we are acquiring some other businesses. So up to how much? More than 50%, as I told you. So if you hold 60% or if you hold 70% also, we are doing the accounting for that as per business combination. Okay. Sometimes we will purchase the entire business, 100% of assets and liabilities when we are purchasing. That means we are purchasing the net assets of another company. Net assets of another company. Net assets means assets minus outside liabilities, which we can call it as equity plus reserves and surplus, whatever it might be. When you are purchasing the net assets of that company, so 100% you acquired, 100% of the company when you are acquiring. So in such conditions also, consolidated financial statement is not required because the other company will stop doing the business activities. Okay. So here, X Limited purchased 100% stakes of Y Limited. X Limited purchased 100% stakes of Y Limited. Now, Y Limited will not do any business. So, Y Limited business also who is doing? No. X Limited only. Then consolidated financial statements is not required. Okay, because everything under the hands of X Limited. So, they will prepare only SFS. Only SFS they will prepare. CFS is not required when you purchase the entire businesses. Okay. So when you are acquiring 80% of stakes, remaining 20% is not with us, right? Remaining 20% is not with us. That remaining 20% we can call it as here non-controlling interest. Non-controlling interest. This is the word, it is important. Those are coming from CA inter background. Minority interest. Minority interest and non-controlling interest is one and the same. But we have to use as per Ind AS language, non-controlling interest. So non-controlling interest means that we are not having the control on that. This 20% we are not having control. We are having control only on 80% of stakes. So in such condition, how to do accounting for non-controlling interest also we will see. Okay. So that means enter the assets and liabilities of Y Limited. Assets and liabilities of Y Limited, we are having a share only 80%. Remaining 20% will be there for outsiders, other shareholders or anyone else. So in such condition, for non-controlling interest is there, how to do accounting in the business combination also, we will do it here. So that is one of the aspects you need to remember. First of all, when we are acquiring 100% of stakes, in such conditions, CFS is not required. Okay. When you are purchasing entire net assets, then CFS is not required. At the same time, when you are purchasing 80% or 70% stakes, so then it is required that CFS we have to prepare, SFS also we have to prepare, because we are not having entire control over the business. Only to the extent of 80% we are having control. We are having majority of control. Who is having, Nana? Majority of control. X Limited is having all the decisions in Y Limited will taken by X Limited only, because they are having the majority of control. Okay, majority of shareholders are with X Limited only. Okay, so that is one aspect. Write down some important notes. Just put notes. First point. If investments are more than 50 percentage, in this case, investor company is known as parent company. Investor company is known as parent company or acquirer company. Acquirer company. So the company who holds more than 50% of stakes in other entity, so then we can say our company will be the acquirer company. Acquirer company is a major word. So most of the cases they will use parent company and acquirer company. Okay, holding subsidiary, old aspect. So here parent company or acquirer company means that company having more than 50% of stakes in any other company. Now second point. Investor, comma, its subsidiaries, investor, its subsidiaries or associate companies or associate company or joint venture company. Or combinedly known as group. All together we can call it as group companies. Investor, either holding company or parent company, as I told you. Investor, its subsidiaries. Investor and its subsidiaries. If you're having subsidiary company, investor company and that subsidiary company together a group. Or if investor company having associate company, then investor company and associate company is one group. If investor company having joint venture company, investor and joint venture together, we can call it as a group. So group means here investor or its subsidiaries or associate companies or joint venture companies, all together we can call it as a group companies. So that's why we are preparing group financial statements. That group financial statements only we can call it as consolidated financial statements. Okay, so third point. This is the first point. If investments are more than 50%, no, parent company is an acquirer kada. Parent company will be the acquirer, Nana, because who is acquiring 50% of stakes? Parent company. Who is holding 50% stakes means how you hold the 50% stakes, you have to acquire their assets and liabilities. So then only we can say it is an acquirer company. So acquiree company means the other company who is giving the 50% stakes to some others. Okay. So that is acquirer only. My confusion unda అందులో అర్థం లేదా? సో ఇక్కడ చూడండి, if X Limited is a company, X Limited purchased equity shares of Y Limited. Simple example, X Limited purchased equity shares of Y Limited. Here in Y Limited we are having 1 lakh equity shares. 1 lakh equity shares. I'm not saying about capital, equity shares. 1 lakh shares Y Limited having. In this, more than 50%, which is nothing but 60,000 equity shares is purchased by X Limited. In such conditions, we can say more than 50% of stakes we are having. So then X Limited is acquired how many stakes? 60,000 stakes. So X Limited will be the acquirer company, which is acquiring. So Y Limited will be the acquiree company. So here Y Limited having 1 lakh shares. Out of 1 lakh shares, 60,000, more than 50% of shares are holded by X Limited. So X Limited is a holding company, we can say in our old language. That holding company will be the parent company, and the parent company also we can call it as acquirer company, because we are acquiring the other company shares or stakes. Okay, so third point, accounting for investments. Accounting for investments in subsidiaries, associates, and joint ventures. So accounting for investments in subsidiaries, investments in associates, and joint venture shall be done in a separate financial statements. As per 27, separate financial statements. Investments in associates, investments in joint venture, or investment in subsidiaries, separate financial statements we are preparing as per Ind AS 27, right? So Ind AS 27. So Ind AS 27, so generally it deals with separate financial statement. As per Ind AS 27, when we are doing accounting for investments, this is only for understanding aspect. Investments generally they have to record it at cost. Nana. Investments are recorded at cost. When you are making separate financial statements, so investment in subsidiaries, in the balance sheet, how you will write, Nana? Investment in subsidiary company. For example, X Limited balance sheet we are writing, my subsidiary company is Y Limited. So investments in Y Limited. Like that you will write. And you are having some associate company A Limited. So investment in A Limited. Like that you will write, no? When you are doing an investment. So these investments will be recorded generally at cost. For which price you purchased, for how much you invested in that company, the cost price we will record. But sometimes when you are following, or at cost, every time at cost, but when you are following as per Ind AS 109, as per Ind AS 109, Ind AS 109 means financial instruments. When some condition, if Ind AS 109 we are applying, in such conditions we will record it at fair value. Usually we are recorded at cost value, but when you are following Ind AS 109, sometimes when we are recorded at fair value. Okay, so Ind AS 109 is saying that investment should be recorded at fair value. Okay, or otherwise we will record it generally at cost only. Because what is the difference between cost value and fair value? When I am making investment, I purchased equity shares of another company. Each share is 100 rupees. I paid 100 rupees, then that is my cost. So I will write at 100 rupees only. Now in the market, the price of that equity share from 100, it moved to 110. Okay, that is the fair value. That is the fair value. When we are following Ind AS 109, we will record it at fair value. Okay, so when you are making other than 109 requirements, we are having at cost value only. This is only for understanding, not required anywhere. In business combination, we are not using that. Okay, so just to understand, because separate financial statement aspect we are having no. When we are preparing separate financial statement as per Ind AS 27, when we are making investments in joint venture or investment in associate company or investment in subsidiaries, all the three cases, case number 2 and case number 3 and case number 5. Okay, case number 2 is investments in associate, case number 3 is subsidiaries, 5 is joint ventures. 5 is joint ventures. When we are making that, you are preparing separate financial statements as per 27. In that 27, as per Ind AS 27, generally investments are recorded at cost, or sometimes when you apply Ind AS 109, you have to record the same investments at fair value. At fair value. So that is the meaning in that. Okay, so before introduction of Ind AS 109, generally investments are recorded at cost price only. But as I told you, this major purpose of introducing this Ind AS, everything will be recorded either at fair values only. This is the fair value measurement aspect. Okay, so that is about the thing. 3 things that we have discussed here. First of all, more than 50% of stakes when you're having, that company will be a parent company or acquirer company, and investment and its subsidiaries, associates or joint ventures, combinedly we can call it as group companies. Combinedly we can call it as group companies. And accounting for investment in subsidiaries or joint ventures or associate companies, we are preparing separate financial statement as per Ind AS 27. As per Ind AS 27, investments generally recorded at cost. When you are applying Ind AS 109, we will record it at fair value. Okay, Ind AS 109, when we are discussing, you can understand that aspect. Okay, so there we having lot of requirements, reclassification of financial instruments, all the things that it comes under Ind AS 109. It is not our aspect at present, just for understanding sake. Okay, so tomorrow in the next session we will go with the definition of business combination, what is business, what is control, and how to do the accounting under acquisition method. So tomorrow we will discuss that. Thank you.